Good afternoon, everyone, and welcome to a webinar hosted by Bernie Wealth Management. My name is Bijal Patel, and I'm a Senior Wealth Advisor here on the team. I'm joined by my colleagues Adam Newman and Kyla McFarland, along with other members of senior management. We want to thank you for taking the time to join us today. Before we jump into the content prepared for today, I'd like to go over a couple of quick housekeeping items. First, we've allotted 1 hour for the webinar, with the first 45 to 50 minutes on content provided by our team and the remainder of the time with Q&A. Questions can be submitted throughout the presentation, but to keep to our schedule, we'll hold off on addressing questions till the very end. You can submit your questions by selecting the Q&A icon on the top left-hand corner of your screen. Any questions that we do not get to by the end of the presentation today will be addressed as part of our follow-up with you, which will be outlined before we close out the presentation. Thank you for joining us today. Adam, you now have the floor.
Thanks, Bijal, and thanks again, everyone, for joining us. Before we get into the content, I'm going to focus on the formatting and just outline the structure of the presentation and how we're going to break out the difference between, informing you around the major changes with the new tax law, but also providing detail around how it might pertain to your particular situation. So it's going to be presented under the umbrella really of 3 key themes that we've dissected from the change in the tax law. We're going to give you a headline, really a headline change for each of these themes. We're going to dive a little bit deeper into the new law and the specifics. And then we've got 2 different sub-items here, tax details and tax insights, that I think will help you pinpoint maybe what specifically around each of the sections of the new law might pertain to you, and the questions that you need to ask yourself, as you're working through this and trying to understand how the law might pertain specifically to your situation. And that's just really something I want to kick off by prefacing. We know all of our clients have unique circumstances, especially when it comes to their tax situation. So we'll be very informative around what we outline in the specifics, but the reality is, everyone's situation is different, and your circumstances are going to dictate what aspects of the new law are going to pertain to you and your family and what aren't. So we'll help identify, the questions and the takeaways that you need to go leave away with, but as part of our follow-up and the conversations that we can have, we can dive deeper into what might be specific to you. So just wanted to open up with that, and don't worry as we're going through this. If you've got more questions, jot them down, and as part of our follow-up, we can get a little bit more in the weeds around your specific circumstances and what we might need to do to help you address them. So as we've developed this webinar and the content around it, it was really a result of feedback and conversations that we've had with our clients. So as soon as the law was released in the 11th hour of last year, people were scrambling, ourselves included, just to understand, how do these laws affect me? Are the changes going to cost me money, or am I going to benefit? And how do I position myself to benefit even more? And what do I need to change now and in the future? And what should I be worried about? So you heard, just as a specific example that we'll talk about, with the changes in the deductibility of state and local taxes. There were long lines, especially locally here in Virginia, of people trying to scramble at the final hour to prepay taxes that they can deduct. There were people asking their advisors how they deduct advisory fees. So just the frenzy around it was interesting to track. And so now that the dust is settled, I think we'll be able to get a little more in the weeds and give you some takeaways to start to implement on your own. So just as a quick overview, any new law, especially one that's been as far-reaching as this one, the result of it's going to be a lot of planning challenges and opportunities. But just as a high level, some bullet points on the new tax law. It was the most far-reaching tax reform in over 30 years, so since 1986. But we feel pretty strongly that it's going to impact nearly every person and business. The net result of this is that most Americans are going to see a net positive impact in their bottom line, and we'll talk about why. Interpretations and revisions will continue. So as part of the comment around the end of year, scrambling to understand what's happening, there are still lawyers and accountants out there trying to really get under a good feel for what's changing. Most individual changes in the individual portion of the tax code are actually temporary and are going to expire in 2025. So I'll talk about what that means and why it's being interpreted that way. The new tax law adds just under $2 trillion to the national deficit. So we know there's been a lot of chatter around, our national debt, what that means, and there's been a political battle of reducing that or expanding that at the expense of other goals. So this particular legislation is increasing the deficit quite substantially. And lastly, with regards to the political side of this, it did lack bipartisan support, unlike some of the previous larger tax revisions. So those are just some high-level starting points as we work into the content here. But I kicked off by saying we're going to have 3 key themes that we're going to dive deeper into to present the changes and deliver it to you in bite-sized pieces. So key number 1 is going to be that many of the beloved deductions that we've had for years, they've been eliminated. Some of these specifically will need your attention, so we'll talk about those and what that means. Number 2 is going to be where you live. It's going to make a really big difference in how the new tax rules will impact you. So we'll talk about specific states and why it is that now with these changes, it becomes increasingly more important to make certain home considerations, like the state that I choose to live in, the mortgage amount that I carry, and things of that nature. So the housing side of this is pretty interesting. And then key theme number 3 is going to be the family-related tax issues that come as a result of this. So with regards to the child tax credit, the school funding with the 529 plan changes, marriage, retirement, and estate planning. All of these things are changing, and so we'll talk about the details behind it. So let's just jump right into key theme number 1, which was that the deductions that many of our clients have counted on in the past, many of these have been eliminated or changed. So let's talk about this for a second. And the subset of this is going to be 7 items, related to these changes and what that particularly, from a dollar standpoint translates to. In aggregate, with the changes in the tax brackets and the laws, this is really the first item of news is that your tax rate is likely going to drop from 2 to 4%, or by 2 to 4%. So 4 out of every 5 taxpayers are going to expect a tax reduction with an estimated average savings of about $1,600. So the highest bracket has been lowered from 39.6% to 37%. So higher income earners are actually going to see more of a reduction than lower income earners. And so you have more money to spend, save, or invest. And just the context behind this is the brackets I've got on the left for single filers, 2017 compared to the current law, and on the right-hand side for married filers, 2017 versus the current law. And you can see under each that there's still 7 brackets, but the income ranges have changed. So as a result, most employees are going to be seeing a positive impact in their paychecks. Those specific amounts naturally are going to vary, but you notice just a reduction in the dollar brackets and how that's changed, and that's where you land on that projected average savings of $1,600 nationwide. So in tandem with this, whenever there's a major change in the tax code, and something we encourage is make sure that you double check your withholding amounts. So, on your W-4, you make withholding elections. Sometimes you adjust this annually from guidance by your CPA, or you do this manually. But with the change in the tax tables, especially if you're intentionally trying to get a refund, or if you're on the other end of the spectrum and if you feel like you want to owe a little bit, you can use this. There's actually a calculator on the IRS website. I have the link there, but if anyone wants me to email it to them, I can. you can plug in your projected income and source of income for the year, and it's updated based on the new tax law. And you can determine, based on your most recent pay stub, if you're on track for a refund or to owe money. So I just wanted to point that out, and I can send you this, but main takeaways with the bracket changes, just to make sure the withholding amounts are lining up correctly. And so second point here of 7 has to do with the change in the standard deduction. So if you don't already, you're likely, based on the numbers and what we've seen, you're likely going to start taking the new standard deduction. The standard deduction is just by definition, it's the specific dollar amount subtracted from your overall income before any taxes applied. So there's something called the Tax Foundation. It's a nonprofit organization that does research on taxes and individual investors. They projected that about 69% of households took the standard deduction in 2016, but now it's actually expected to go up to 90% starting in this year as a result of the tax law changes. So with that going up, this is part of the political debate around wanting to simplify the tax code. So if more people fall under the umbrella of just taking the standard deduction versus itemizing, that's a less time spent on taxes and less complexity. So that's just the political angle of it. So net standard deduction going up, the number of people claiming that's going from 68 to 90% based on what's being projected. So in dollar terms, what does that mean? So I've got here for both single, again, and married filing jointly, what the standard deduction was last year and what it is now. So for single filers and married filers, it's actually almost doubling. And that's, again, part of this effort to roll more Americans under the standard deduction. Now, in tandem with this happening, the personal exemption, which was previously $4,050 per individual, is going away. So that's being eliminated. So you used to get the standard deduction, and then you'd get these additional personal exemptions. So what this means is with this personal exemption going away and the standard deduction going higher, that really is going to impact large families who had a lot of individual members, so you had more personal exemptions and a lower standard deduction. So those are I think in the specific cases, the bigger families are the ones that are going to be penalized. And so how they manage this is they get rid of these personal exemptions, but they're lowering the tax applied at each bracket. So different moving parts, and I know this is where you get into the complexity around your particular situation, but that's just the idea behind it. It's the simplification, and it's the lowering of the brackets to try and manage everything all under one umbrella. So just a quick example that kind of ties all of this together. So I've got Jane and John Doe. They're married. They have 2 kids, and they both work with a combined salary of $71,000. So they don't itemize, but they take the standard deduction. They contribute 10% of their overall joint income to a company 401k plan, which goes in pre-tax. So under the previous law, the standard deduction and the personal exemptions would bring their taxable income to about $35,000. And then because they have 2 children, they also get the child tax credit, which would brought their total tax bill to just over $2,300. So under the new law, and again, we're going into bigger households here, they get the standard deduction, which is higher, but don't get the personal exemptions for all 4 family members. So their taxable income is actually higher. And this is the example that I think highlights this best. The taxable income looks to be higher. So it's almost $40,000 versus $35,000. But when they go to apply that income to the bracket, it's actually 3% lower. Under the previous bracket, it would have been 15%. Under this bracket, it's only 12%. So they're actually saving almost $2,000 in federal taxes. So they can cause some confusion. There's different moving pieces of the puzzle, but this is, I think, just a quick example around how this all integrates. So, and that's really the takeaway for you in terms of thinking about your situation. Now, how do you itemize deductions, and how do you manage this, the changes in the tax code, given the personal exemption is eliminated and the standard deduction has gone up? You want to, either calculate this on your own or work with your accountant to understand how this is going to net out to you at the end of the tax year. Key point number 3 is 7 under the personal changes. It has to do with the alternative minimum tax, or AMT, as most of you typically hear it defined. AMT was created to make sure that those taxpayers with a lot of itemized deductions, they still ended up paying some taxes. So it was a side-by-side calculation of your standard tax under the Form 1040 versus the AMT tax calculation to see if you had a lot of deductions, were you being advantaged versus someone else who didn't. So if you're hit with AMT, what happens is you pay your regular lower tax plus the AMT difference. So without getting into too much detail, in the past, AMT applied to a lot of people, but now with the changes in the tax code, you're much less likely to end up paying the alternative minimum tax. So what happens with AMT under the new tax code is the Act increases the exemption amount, so fewer taxpayers are going to be subject to AMT, and I've got the higher amounts listed right here. According to that same tax foundation we talked about earlier, just over 10 million households were subject to AMT in 2015. Many of those lived in a high tax state with household income between $200,000 and $500,000. So with the increased standard deductions, what that means is a lot of households will be swept away from itemizing, so they won't be subject to AMT. And that's going to mean more money in their pockets, especially for the high earners. And then those who still owe AMT, under the new calculation, they might end up owing even less. This again goes back to the whole idea of simplifying the tax code. So question for you is, you might no longer be subject to AMT if you previously were. The numbers are here, and you might want to just start to think about, given we're at the beginning of the tax year, what's that going to look like when you hit the end of December. And just an insight for tax planning, this might particularly be relevant to some people on the call, but exercising stock options through your employer, actually the way it's calculated and the way stock options are treated, they can end up triggering a pretty big AMT liability. So I won't go into too much detail because I'm not quite sure who this will or won't pertain to on the call. But if you have stock options, you might want to just talk through with us what that means if you were to exercise them. And we might want to explore particularly phasing that out over a period of time so you don't do it all in one swoop and get hit pretty hard with AMT. So just think, if you have stock options, just have that asterisk there that's telling you to have a deeper conversation around what that might mean from a tax standpoint. So again, think about AMT, think about these deductions, and how might you minimize that impact and what it means for you. Key point number 4, which I think will apply much more broadly than AMT or the stock option comment, it relates to how much you end up paying for out-of-pocket health care. In 2018 only, this is one of the kinks in this new tax law that really just applies to 2018 before it sunsets back next year. And previously, there was a floor set at 10% of your adjusted gross income, where every dollar spent on out-of-pocket health care beyond that 10% floor of AGI was deducted at your individual tax rate. And there's a special exception for 2018 where every dollar you spend on out-of-pocket health care beyond 7.5% of AGI can be deducted. So this new 7.5% floor for this 1 year, I think it'll lean towards benefiting people with low income and high medical expenses, but it's not just going to be limited to this group, because some individuals with very large health insurance premiums with after-tax dollars or very large deductibles or very significant one-off medical expenses that they could see occurring in the next few years might be able to benefit if you could somehow front load this into 2018 and take advantage of this lower floor. So this 2.5% difference from the 7.5% to 10%. You know, if you've got surgeries or things of that nature or big medical expenses coming up, if you're able to prepay those this year, you might be able to be in a position where you're getting a much more favorable and larger deduction because of that. And so this really captures that. And this, you know, medical, dental expenses, premiums, one-off costs, any of those things, I would say from a planning perspective, just think about your medical situation, maybe make a list of the costs that you can see on the horizon, and just know and be very mindful that you could be in a position to, if we can pay those this year, capture a bigger deduction. So point number 5 here, this is a big one. I would say most of our conversations with clients have revolved around this list I'm about to work through, but this is that group historically in the tax code known as these miscellaneous itemized deductions. So with the new standard deduction, with the elimination of the personal exemption amounts, and with the changes in the percentages applied to each bracket, Congress decided as a cost to all of this to essentially nix all of these miscellaneous itemized deductions. For example, things like moving expenses, home office expenses, investment fees, tax prep fees, professional dues, casualty losses, things of that nature that were previously deductible have been eliminated. So that applies directly to us in our situation where we have clients that are paying advisory fees that are no longer deductible on their tax return. So one of the big questions we've been having asked in our direction is, well, now that I can no longer deduct my advisor's fees or your fees, what do I do? And one of the alternatives that's been thrown out there that is being implemented in many cases is the idea that you are able to still, under the current tax code, have your retirement account fees, such as an IRA, those advisory fees can be paid directly out of those accounts pre-tax, while your taxable account fees, say from a joint account or an individual account, can continue to be paid from those accounts. And I'll explain this a little more detail on what it looks like in practice. So if you have $1 million portfolio, $500,000 in an IRA, and $500,000 in a taxable account, let's call it a joint account, you can have the fee attributed to the IRA pulled out of that IRA account and the fee attributed to the joint account pulled from the joint account. Typically, what we used to see clients do is they'd pay the whole household fee out of the joint account and then deduct that all on their taxes. We know that's gone with the change, but by splitting the household fee and bucketing it out and pulling the retirement account fee out of the retirement account pre-tax, you're essentially putting yourselves in a position where if you're paying it from an IRA, pre-tax money, the money comes out of that account to pay your fee, you won't ever end up paying tax on that money. So it becomes a permanent tax shelter, whereas you can't deduct it anymore. That's still a benefit, I would say, over the long term versus having everything taken out of the joint account now or the taxable account now with really no future benefits. So on a one-off basis and in your situation, we could talk through the benefits or advantages of that, but the IRS said you can pull your IRA or your retirement account fees from that account. You just can't bunch everything up, take it out of a taxable account anymore, and deduct it. So that's a big change that we've seen, and that's something that's really been at least top of mind for a lot of our clients. So the questions that pertain to this is understanding what deductions are available to you in your situation. How does this impact your after-tax investment returns? And then should you pay retirement account investment fees with pre-tax dollars? So all of those things work together to help improve the current tax situation for a particular client. Point number 6 here is the change in the inflation measurement that they use to index upwards certain tax rates, tax credits, and deductions. And I'm going to have to spend a little bit of time explaining this because I know it can be somewhat confusing in interpreting this as a tax hike or a dock on your taxes. But really, a lot of people argue there's a hidden tax here. So they're calling it the tax bracket creep. I just want to explain specifically what that means and why that's important. But all of you have probably heard about something called CPI, the Consumer Price Index. That's a measure used to measure inflation. So it tracks the prices of a basket of goods and services, and it's calculated by taking the price changes for each item and averaging them over a period of time. So that CPI, that Consumer Price Index, was the historical measure that they use to index upward certain tax credits, tax deductions, and tax rates. With the change in the tax law, Congress adjusted or changed the method that they're using to index these figures upward. They changed it from regular CPI to what they call change CPI. And this gets into the weeds a little bit, but it's really important, and you'll see why in a second. But change CPI, it's going to track the price increases of goods and services over a period of time, just like regular CPI will, but it's going to adjust these figures for changes in purchases as consumers substitute certain goods for others. So it's instead of just taking a flat across the board basket of goods and saying how much did this change from one year to the next, it's taking that same basket of goods and it's saying, well, how do consumers weight these different items appropriately, given a typical, American budget. So very confusing to that extent. But what's happening and why it becomes really important is under the new legislation, the marginal personal tax rates, the credit, the deduction, they're going to be indexed to this new change CPI figure, and that measures the growth of cost of living more slowly than the old law. So even if you don't understand the difference between the two, just know that change CPI is going to index upwards at a slower rate. So what that means is that because of this, as you're getting, let's say from an income perspective, as you're earning more money through time, say your employer gives you raises matched with the regular inflation, your salary and your wages are going up, but the inflation measure that is linked to your credits and your deduction is going up more slowly behind that. So you're actually moving into higher tax brackets as a result of that. So if you earn $100,000 a year and the next year you earn $110,000, and the standard deduction and maybe certain credits that you're entitled to index up more slowly or at a rate lower than that, your taxes are going to be higher from one year to the next. So just as a result of changing the method in which certain credits or deductions are adjusted upward, just by changing the school of thought behind that, what's happening is your getting a behind-the-door tax increase that wouldn't be apparent just by looking at the new brackets. So I don't think there's really anything you could do about that right out of the gate, but it's just something to be aware of. Know that this measure is going to be growing more slowly than typically than what your income is going to be growing at through time. So this change CPI measure is going to be potentially also creeping into Social Security benefits. That's not something that's on the table as a very specific action item today, but what they're considering is using change CPI instead of regular CPI to index upward Social Security benefits every year. And obviously, as we know, that figure grows more slowly. So what that could mean for you is that Social Security benefits are indexed upwards at a slower rate, meaning you might have to fund more of your own retirement through potentially a long period of time. So again, not on the table right this second, but just know if you hear about that in the news and that becomes a political battle with the deficit, it could become a reality sooner rather than later. So really the big question behind this is, although it's complex in nature, but try and understand how the growth in your income and your earnings through time are going to coordinate with these slower growing deductions and credits, and how that might penalize you and how that might impact your ability to save for certain goals, especially retirement. And one of the ways to leverage this is to somehow come up with creative ways to increase your deductions even if you're not itemizing. So certain things I'll point out specifically under point number 7 as a positive change in the tax code behind some of the limitations is that you can now deduct more of your donations to charitable organizations. So while many deductions and exemptions have gone away, this is an example of one of the few that has actually improved or gone upwards. So for charitable contributions, you can make deductible cash and stock contributions to public charities for now up to 60% of your AGI when it was previously 50. So they bumped that up by 10%. So a lot of nonprofits and other organizations that are qualified by the government, they're going to be seeking bigger donors who can now donate a higher percentage of their AGI to charities. So I'm going to talk about bunching deductions in a little bit, and this will be part of that conversation. So just think about, let's talk about giving strategies in the context of this increase in deductibility. So as an example, instead of donating cash to charity, a lot of things that clients aren't aware of is that you can donate appreciated stock. So this works out really well when you've got a taxable portfolio with stocks that are highly appreciated and you've owned them for more than a year. You can get that same deduction as you would, if you just wrote a check with cash, but you're also then getting away from paying capital gains tax on a highly appreciated security. So say you're going to rebalance your portfolio with the run up in the markets. Say you want to take some stock exposure off the table. Instead of selling shares of, let's say, Apple as an example, paying capital gains tax and then writing a check to a charity with the proceeds, you can actually gift the shares of that stock up to certain share, you can use a share amount or a dollar amount and make a gift to a charity, and then you write that off on the tax return. But then you also, in tandem with that, you never have to pay capital gains taxes. So that's a really big one that a lot of clients aren't aware of that you can consider in the context of the new tax law. Another is a donor advised fund. I'd say another area people are very unfamiliar with, but a donor advised fund can allow you to make charitable contributions and receive an immediate tax benefit. So it's an investment account that you can deposit cash, stocks, or bonds into and get a deduction in that tax year. And then over time, you can distribute from that fund or that account, you can distribute cash to charitable organizations. So the benefit there is, let's say for 2018, you're going to have a really high income year, and 2019, you're going to have almost no income. Instead of doing a little bit this year and a little bit next year in terms of charitable giving, you can front load it all into a donor advised fund in 2018, take an immediate tax deduction, and then still pay out to the charity over a period of time. So it's a good way to get control over the distribution of funds to organizations while also in tandem getting an immediate tax benefit. So between that, the medical expenses I discussed, and the stock donation and the avoidance of capital gains, this all falls under the umbrella of what they call bunching deductions in alternate years. And I'd say if there's any takeaway from this particular presentation that I would explore in much more detail and see how it might pertain to your situation, it would be the idea of bunching your deductions. So I'm just going to explain what that means and how you coordinate with an accountant to make this happen. But what happens is, especially with the loss of the deductibility of a lot of these exemptions and especially the miscellaneous itemized deductions, is, it could become possible to take the standard deduction in one year and then itemize a bunch of grouped together deductions in the next year, which can entail things like prepaying real estate taxes, mortgage payments, medical expenses, and future charitable contributions. So it's a strategy that allows you to take advantage of higher itemized deductions in one year and then taking a standard deduction in the next year. So just some quick examples. So say you determine you can contribute a lot of money to a 529 plan one year. Let's say you can prepay certain state and real estate taxes, prepay some medical expenses, and make a really big charitable contribution in 2018 as an example. The combined value of all of that might far exceed your standard deductions. So you can do that this year, receive a more advantageous tax picture, and then next year just go back to the standard deduction. So that gap and that difference might be attractive enough where you want to consider that. So this is where you have to get in the weeds of quantifying things, but if you work closely with an accountant, or if you want to talk to us about it, we can talk through in concept what it looks like to group things or front load certain activities in one year so that you get a really nice tax benefit and then just go back to the new higher standard deduction in the next year. So it could be over the long term something that should be considered, but I just want to bring that to light as something that's definitely a consideration. And so under key number 2 now, where we go into the housing side of this, really pertaining to state and local impact, state and local income taxes, it's just the idea that where you live is going to make a very big difference in how these new rules impact you. And there's really 2 important items about taxes and home ownership that are a key takeaway from our review of the new tax bill and what that might mean for our clients on a dollar basis. So here's the first one, is that homeowners in high state taxes are going to lose their ability to fully deduct state and local income taxes, which they've been referring to as SALT. So the SALT deduction has been around since 1913, and it allowed for previously an unlimited deduction of state, county, school, municipal taxes to avoid being taxed twice on the same income and to promote, I think a big thing is just to promote home ownership. Now that deductibility has gone from being unlimited to being capped at $10,000 for all state, local property and sales taxes. So it's a huge, we think a really big difference, especially for clients that live in certain states. So It's going to be felt mostly in places like California, Illinois, Maryland, Massachusetts, New Jersey, New York, Connecticut, states that account collectively as probably for more than half of the value of all of these deductions that were previously taken. So the high tax states, especially when it comes to property taxes, that's going to be, that cap and that change is going to be a big one. And this ties into the year end of 2017, people promoting and even sometimes states promoting the prepayment in 2017 of future year property taxes. And that was something that's still being interpreted, because what happened is these properties they had to be assessed by the end of 2017. In a lot of cases they weren't. So still trying to understand the full impact of that. But I still think going forward, these high tax states, they don't want to become significantly less attractive than other places. So they don't want people moving out of their state and relocating if the tax gap is really that significant. So I do think you'll see conversations around state-related programs to credit this back or make adjustments at the state level. Some of you may have already been hearing about this, but as it stands now, it's a big difference. And so we've got to give you some considerations with this and how this might impact the trajectory of your financial outlook going forward. But if you live in a high tax state, what you're going to want to potentially consider is, first off, revising your financial plan and your projections, especially on the cash flow side, to account for the change in this deduction and what that means in terms of inflows and outflows for you on a year-by-year basis. We've seen a lot of clients considering relocating to a more tax-friendly state or downsizing. And lastly, we've actually had, given the change, significant number of clients considering or playing with the idea of paying off a mortgage in full or in part over some period of time. So the question is, how do you account for this, and how do you make changes in light of all of this? So existing on the mortgage front, with the mortgage interest deduction and why people are considering making significant payments towards their mortgage, either eliminating it or paying off a portion of it. Existing mortgages under the new law, they're going to be grandfathered in to the extent that the original loan amount does not exceed $1 million. But going forward, that limit has been changed for future debt to $750,000 in terms of, what point can you deduct mortgage interest up to. And then the big thing under the new law is that home equity loans are no longer deductible unless they're used in connection with a home acquisition or making significant improvements. So a mortgage interest deduction changing, there were some out there that worried this could cause housing prices to fall or, significant changes on that front. I don't think we'll see it, but just know with the deductibility changing and with the dollar amounts fluctuating, that home ownership is just being revisited in terms of the pros and the cons and the costs. So, obviously still a great method to build wealth for the future. It's an asset on the balance sheet, but when it comes especially to retirement, the state that you live in, downsizing, paying off a portion of the mortgage, I think all of these different moving pieces have just been changed. The game has changed, and these are things that have to be considered and accounted for. And it's important to walk through the pros and the cons of what that means from a dollar perspective for you and your family. So lastly here, as we move into key point number 3, and then get into questions, which you have a handful of, just pointing out the family-related tax changes, of which there's about 6 of them. So under the old tax law, the child credit was $1,000 per child. That's actually gone up to $2,000, and that the phase out for that credit has gone up significantly. So more families can now claim if you've got children and you're single and your income's below $200,000, or if you're married filing joint and your income's below $400,000, you're going to be in the ballpark to claim the child tax credit. And this credit now is fully refundable up to $1,400, even if no taxes are owed. So let's say for whatever reason you're in a position where you're not owing any taxes at the end of the year, you can still claim the credit for a refund up to $1,400. I'm not sure how they came up with that amount, but that's something to know, that the child tax care credit expanded and that it's now fully refundable up to a certain dollar amount. Point number 2 here is 529 education savings plans, which historically have been a vehicle to save pre-tax for college tuition and related expenses. These 529 plans can now be used to pay for K through 12 education, which is, I think, a very attractive proposition, especially for those sending kids to private schools with high annual costs. So with the 529 plan, what happens is if you put money in up front, most states will give you a tax deduction for putting money in. That money is invested and then grows tax deferred, just like an IRA or 401k. And then in a 529 plan, it comes out totally tax free, whatever the growth is, and your principal comes out tax free. So it's a triple tax benefit: deduction up front, tax deferred growth, and then comes out tax free completely. Now, the political angle of this is a lot of, depending on where you land on the aisle, it doesn't really matter. But a lot of people feel like this is trying to push money more towards private schools. I think that's an argument that's been made. But the reality is, for this new expansion of the 529 expensing, I still think it's attractive that you can use this for private school funding, and there's a cap on that for $10,000 per year. So if your tuition at a private school is $30,000, you can pull up the $10,000 for from a 529 plan. So one of the things to consider is, should you participate? What type of 529 plan should you invest in? Do you get a state tax deduction up front? And then for your children, when you're looking to fund their education, coming up with a plan around how much should I be saving and how should those resources be allocated. Next for 2019 is the divorce category. So rules have been made a while ago in terms of the taxation of alimony for those that are paying it and for those that are receiving it. Usually not a particularly pleasant situation, but in 2019, rules are changing for how alimony is taxed. So alimony is no longer going to be a deductible expense for the person paying it, nor is it going to be considered income to the payee. So for the last 75 years or so, alimony was actually deductible if you paid it, and it was tax-free if you received it. So we hear about the numbers around divorce rates and what that means in terms of demographics, but 2019 is going to be a big wake-up call, especially for those divorcing after 2018, where the tax benefit for both parties is going to be washed away. So just a consideration from a financial perspective, the tax implications of divorce. Attorneys, they might have to find interesting ways to do more with less. It could be, the net result could be less money for both households. So I think it's just from a tax and a legal perspective going to be interesting to see how this gets handled. But just a consideration if it impacts you directly. So big one here, Roth conversions and how they've gotten trickier. When you make a Roth conversion, you take money out of a IRA account, you pay full income tax when that happens to the extent that you pull the funds out of the IRA, but then you immediately deposit those funds into a Roth IRA where they can then grow tax-free and come out tax-free. So it can be an incredible tool long-term, but one of the things with the Roth conversions is you used to be able to recharacterize or change your mind and go back from a Roth to a traditional. You can't do that anymore. They got away with the recharacterization. So one of the things we help clients quantify is, how much should you characterize the Roth? When should you do it? I think at least now you should start thinking about this more towards the end of the year because you can't recharacterize. And one of the ways to manage this through time is to consider doing smaller Roth conversions over several tax years. They call that filling up the buckets. So doing little amounts over time to spread out the tax hit. You need to consider your future cash flow very carefully and the ability to pay the tax bill when you do convert, because again, you can't recharacterize. And then consider the timing for later in the year, which I already touched on. That's a big one. And one of the ways to hedge this is to consider if you're still working and you're still saving, depending on where your income lands, it might make sense to contribute a little bit to a traditional and a Roth IRA. So it's spreading out your resources across different tax buckets. And when you're planning for retirement or you're saving, the number one thing that you want is flexibility. So if you have flexibility in terms of the tax treatment of funds, if you have flexibility in terms of the way funds are taxed when they're put in or taken out, that's really a very important planning objective is, saving in the different types of buckets so that you can leverage them all in the future to make the most attractive income situation as you possibly can. So as a cap off on the estate planning side of things, one of the things that happened under the new law is, we know how estate taxes work and how the estate tax rate is much higher than the standard tax rate. The individual top estate tax rate of 40% now applies on estates over 11.2 million. It was previously 5.6 million. And for couples, you just double it. So if you're a married couple, that estate tax hits once you get over 22.4 million in terms of your taxable estate. And if you're single, 11.2 million. So from an estate planning perspective, these numbers, when they're changing the limits and when there's a state legislation, it's very important to understand, do I need to make an update to my estate plan and why? So a lot of individuals and couples had estate documents, whether it's a trust, revocable or irrevocable, different types of estate planning vehicles based on older laws. Some of those trusts and the cost of administering them might have gone away completely if you don't hit some of these limits. So it's just being mindful to revisit what that looks like from a personal estate planning perspective. We would say wills, trusts, all of those documents should be reviewed at least every couple of years just to make sure you're keeping up with the estate laws. So from a planning perspective, that's a big takeaway. And so this is from a high level view, just the initial content. Bijal's going to close out, and then we're going to take some time. We can be flexible on our timing here to tackle some of the questions that we've gotten.
Great. Thanks, Adam. Every time we go over this information, I seem to pick up something new. It just really highlights the fact that this particular topic is individualized to each person and each person's particular tax situation. So now is a great time to be thinking about this and doing some planning before we get into the second half of the year. Before we get into your questions, I want to make some quick closing comments. On behalf of Bernie Wealth Management, we want to thank you for your time today. We hope it was as valuable and educational as we anticipated. Kyle McFarland from our team will be reaching out to you over the next several days to discuss your questions and gather some feedback. Kyle's information will be shown on the screen shortly in case you'd like to reach out to him directly. Now let's tackle some of your questions.
Okay, we've got a few questions here on the advisory fee discussion. I think this doesn't on the surface sound intuitive, and it can be confusing. But with the advisory fees, I'll just go back to previously what we could do, which was you used to be able to pay all of your investment advisory fees out of a taxable account and then deduct that or itemize that on your tax return. So if you paid, let's say as an example, $10,000 in advisory fees one year, and all of those fees were pulled from a taxable account, that went on your tax return as a miscellaneous itemized deduction as long as it was above the 2% floor. So if you had IRAs, SEP IRAs, Roth IRAs, what you typically do is say, well, what's my household advisory fee? I'm going to pull that all out of my one taxable account, and then I'm going to deduct all of that on my tax return. That went away. So the Congress said we don't want people doing that anymore because that's too large of a tax benefit. So there's two alternatives to manage that. You either A, just keep doing what you've been doing and not deduct it anymore, or B, there is still a rule within the tax code that allows you to pay advisory fees out of your IRAs. The problem is you can't pull your whole household advisory fee out of a retirement account. You can only pull the fee associated with the retirement account from that specific account. So back to that example, if you have $500,000 in an IRA and $500,000 in a joint account, and your annual fee is $5,000 from each account, you can only pull, if you want to pull from the IRA, you can only pull $5,000 from the $5,000 fee from the IRA and then pay $5,000 from the taxable account. That taxable account fee is no longer deductible, so you don't get any benefit there. But on that $5,000 fee that's pulled from the IRA, that money's coming out pre-tax. So when you made the contribution to that IRA, you did not pay tax on those funds. When you're paying your fee, you don't pay tax with those funds. And as your account grows through, what happens when you hit 70.5 is you start having to take RMDs. So that money that you use to allocate towards your fee, it essentially never gets taxed, and then it never gets applied towards your required minimum distribution. So it's not a tax benefit in the sense that it's deductible. It's a benefit in that it's allowing you the ability to no longer pay tax on those dollars into the future. So we have another question also on charitable contributions and other strategies. I would say one of the things for those over 70.5 with regards to managing taxes with RMDs in the picture is there's something called a qualified charitable contribution. You're actually allowed to pull money out of your IRA. If you're over 70.5, you can pull money out of your IRA and make a charitable contribution up to a certain dollar amount, and that money reduces your RMD for that year, and then you don't pay tax when the money goes to the charity. So let's say you had let me use a smaller number, say a $20,000 RMD in 2018. If you take $10,000 of that directly out of your IRA and give it to charity, your RMD goes down from 20,000 to 10,000, and then you only pay tax on the remaining amount when it comes out of the account. So you have to report that a certain way on a tax return. But for clients, I've seen a lot of clients that have been taking these big RMDs and then on the side giving money to their church or synagogue or whatever it is with cash. And that's really, I would say, net doesn't make sense because you can reduce your taxes every year by using the RMD as a method for charitable giving. Another question on Roth conversions and how that is managed through time. Why would you manage Roth conversions through time? I think is the question here. The big one, I would say, is with Roth conversions and the integration with the new tax brackets. A lot of people think it's all or none. You know, they think that when they make a Roth conversion, they have to do a full account or a full dollar amount in 1 year. And they're saying, you know, if I have a $500,000 IRA, if I convert all that to Roth this year, my tax bill is going to be huge. Well, I would agree. And what we would say is, with the new, especially the new lower tax brackets, and this will remain, let's say, for the next few years, you can break it up over time and say, this year I'm going to do 100,000 based on my income. Next year I'll do 50. The final year I'll do 200. But it's phasing out Roth conversions over time so that ultimately you're converting money from one tax bucket to another that's much more favorable, but you're doing so in a way that you're managing taxes and you're not ever pushing yourself into unnecessary, much higher tax brackets. So I think that's something that's, in terms of quantifying it and managing that in the context of your plan, becomes very important. So we're up on 1:30, so I want to be mindful of everyone's time. Anyone else that submitted questions, we've got them here, we've inventoried them, so we'll respond to you personally in email with an answer to your question. And also, Kyle or another member of our team will reach out. We can give you copies of the slides. We're also recording the presentation. So all of this will be available. It's out there, and we'll make sure we get your hands on any other information that you need. But thanks again, everybody, and enjoy the start of summer.